Hi everybody, my name is Griffin Bridgers. Today it's my pleasure to introduce a quick presentation on a just published private letter ruling 2022-20009. And it has a history lesson that I think is important to highlight for some of you out there, dealing with GST tax exemption allocations, whether automatic or manual, from the year 2010. So, a little bit of an interesting sliver of time. We're going to kind of look at how that affected things in the GST tax world, because what a lot of people remember is what happened in the estate tax world then, but they often forget a rare moment of time where there was no GST tax. Now, before we dive in, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So jumping in, if you don't know much about the generation skipping transfer tax or the GST tax, it's important to note that every individual has a GST tax exemption which is equal to and applies in parallel to their estate and gift tax basic exclusion of $12,060,000. So you have both a $12,060,000 estate tax exclusion and a $12,060,000 GST tax exemption. Now I want to note that I've emphasized the basic exclusion here because there's no way to preserve an unused GST tax exemption for a surviving spouse from the deceased spouse. So while you can preserve a deceased spouse's unused estate and gift tax exclusion, the DSUI, through a portability election, that election does not apply to the unused GST tax exemption. Now I bring that up to mention that the GST tax is a flat rate of 40%, but unlike the estate and gift taxes, it is not dependent on tax brackets. Instead, there is a unique function where that rate is affected by the inclusion ratio, which is determined through the allocation of GST tax exemption. So, the allocation of GST tax exemption directly affects the GST tax rate, which is how you can lock in a GST trust's exempt status and preserve that exempt status even if the value of the trust grows. There's also some types of transfers, maybe direct, maybe indirect, that are exempt themselves from the GST tax. So if you fully allocate enough GST tax exemption to a transfer, you can achieve a 0% rate. But some transfers, per se, already get the benefit of a 0% GST tax rate, technically. That's how they are exempt. So what does that mean? Well, it means that if you have a transfer that's already exempt from the GST tax, in other words, a transfer that already has a 0% GST tax rate, you don't want to allocate GST tax exemption, because remember, the only reason to allocate GST tax exemption is to pull yourself down from that flat rate of 40% to optimally a 0% rate. So, I know that seems like splitting hairs, but it has some relevance from the year 2010, because if you were around at this time and practicing, you may recall that there were the Bush tax cuts in EGTRA. I colloquially call them the Bush tax cuts because they were enacted in 2001. And one element was the estate tax, which had a progressively increasing estate tax exclusion, which started at $1 million, then went to $2 million, then up to $3.5 million. But the estate tax was set to sunset in 2010, and at the end of 2010, it was set to go back to its levels pre-2001, which would have brought back an exclusion amount of $1 million and a higher estate tax rate. But for 2010, there was this temporary sliver of time where there was no estate tax, and instead it was replaced by a carryover basis regime, which meant that even though there was no estate tax, there was no step up in basis under Code Section 1014, other than a limited basis step up that you could allocate under Code Section 1022. So we had this temporary window of time in 2010 where nobody knew what was going to happen with the estate tax. Was it going to come back? Was it going to be extended at the old exclusion? Or was there going to be further relief? And at the end of 2010, on December 17th, there was new legislation which created a new permanent $5 million estate tax exclusion, which was applicable to both the gift and the estate tax. So you had a $5 million exclusion for gift tax, a $5 million for estate tax, which wasn't the norm before. They used to not be unified, where you just had a $1 million gift tax exclusion and a higher estate tax exclusion. But that was added in, and these were subject to a new concept, portability, where a deceased spouse's unused exclusion could be preserved for the survivor, like I said, but not the deceased spouse's unused GST tax exemption. So both of these, the unification and the portability, were relatively new concepts at the time. And this change was made electively retroactive for decedents who died in 2010. So, and that should say 2010, not 2009 on the slide. So effectively, it meant you could choose either an estate tax with an exclusion of $5 million if you died in 2010, or a carryover basis regime with no estate tax, but using that limited basis step up under Code Section 1022. And the procedures were clarified in IRS Notice 2011-66, which I'm not going to get into great detail on, other than the fact that it ties in to the private letter ruling we're going to talk about today, especially in the area of GST tax, because effectively for 2010, the GST tax had also been repealed. And really what this notice I mentioned clarified is that there was, in essence, a 0% GST tax for direct skip transfers occurring during 2010. So what that meant is that if you made a direct inter vivos transfer to a skip person in 2010, it was subject to a 0% GST tax rate. But I want to remind you again that the GST tax exemption is the tail that wags the GST tax rate dog, meaning that in 2010, any allocation of GST tax exemption to a direct skip would have been wasted. And I want you to remember that GST tax exemption can automatically be allocated even if there is no gift tax return timely filed, or even if the allocation of GST exemption on the gift tax return itself is left blank, which I have seen many practitioners do. CPAs, attorneys just kind of ignore the GST tax part of the gift tax return and assume, okay, everything will work itself out. Well, that's not always the case, and as we're going to see, that became an issue here in today's fact pattern in this private letter ruling, because we had a donor who in 2010 had made gifts first to a trust solely for grandchildren and more remote descendants, which effectively made the trust a skip person and thus the transfer to the trust a direct skip. And there were also some direct gifts to grandchildren as well in 2010. Now, an accountant in 2010 had filed the gift tax return but did not elect out of the automatic allocation of GST tax exemption for the direct skips. And the attorney was kind of thrown under the bus here. The accountant said, well, due to an ineffective communication from the attorney, I didn't do this. So that's its first lesson in and of itself. But the result here was a wasting of GST tax exemption for these 0% rate transfers, these direct skips, which occurred in 2010 and were then discovered at the donor's death. So the donor died. It was discovered some GST tax exemption had been wasted, thus reducing the amount that could be allocated on the 706 at the time of death. So in this PLR, the client or the decedent's estate really requested, and the IRS gave permission for an amendment to the 2010 gift tax return to elect out of the automatic allocation of GST exemption to the direct skips, which happened on the gift tax return in 2010. So, big lesson here is that, in 2010, direct skips were subject to a 0% rate, and allocation of GST tax exemption to them was not necessary. And if you don't do anything, there was automatic allocation to them. So what are our lessons here? Well, while narrow, I think it's important to check, first off, your client's 2010 gift tax returns to see if any were filed in 2010, and to be conscious of the effect of those 2010 elections, especially for direct skip transfers that were set forth in IRS Notice 2011-66. I'd encourage you to read the procedure a little bit more on how returns were treated then, because effectively it said if you filed a return and reported a direct skip, then you were credited with the 0% tax rate, but unless you manually elected out of GST tax exemption allocation, it was going to be treated as being automatically allocated. So you needed that manual election out, and that's what we did not have. So make sure on your client's 2010 gift tax returns that if that was the intent, there was an actual election out statement filed. You want to make sure there was no GST tax exemption allocated automatically or manually to direct skips in 2010. And I think it's also important to consider the bigger picture here. Now, obviously, if you're dealing in the gift tax world, another thing to think of is that there used to be a code section 2511C that was designed to be effective for 2020 or for 2010, which was retroactively repealed. And what that code section would have said is that transfers to a grantor trust, for which the deemed owner was the grantor or the grantor's spouse, was not a gift for gift tax purposes in 2010. So I could see people getting lulled into a false sense of security and making that transfer, hoping there'd be no gift tax, and then retroactive repeal of that, and then discovering, oh no, there was a actual taxable gift made in 2010, which we didn't know was taxable once December 17th of 2010 hit and this new tax legislation was enacted. So it helps to go back and check that too. So big picture here, check for gifts made by clients in 2010, either which misreported GST tax exemption or which didn't even report at all a gift which was thought not to be taxable but actually did end up being taxable. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. And if you like what you've heard here, if you'd like to work with me more, especially as a speaker, you can reach out at my email address as well. I'm always happy to present to state planning councils, FPA chapters, any other group that has the need for a dynamic estate planning speaker. But I thank you for listening to today's presentation, and I look forward to seeing you in my future content.